Imagine owning the only multi-lane toll road leading directly into the world's most energy-hungry technology hubs. You don't have to care what the trucks are carrying, you don't care about the price of the goods inside them, and you don't even care if the economy is booming or busting. You just sit there and, well, collect hard cash for every single vehicle that passes through your gates.
Yeah, it's the ultimate business model, really.
Right. Today, we are looking at a company that is quietly doing exactly that for natural gas. Welcome to the Byte-Size Brief. Today, we are putting Antero Midstream AM completely under the microscope. Let's get into it.
It's fantastic to be here for this analysis, especially considering the timing. We are sitting here on April 4th, 2026, and Antero Midstream AM has just executed some of the most aggressive strategic shifts we've seen in the midstream sector in years.
Oh, absolutely. The scale of it is wild.
Right. We are talking about a simultaneous billion-dollar acquisition and a massive divestiture, all happening right as they report their Q4 2025 earnings. So our mission today is to tear into the actual mechanics of these deals, look past the headline numbers, and figure out if the stock's recent surge to 52-week highs is, built on solid fundamentals or just market hype.
And for those listening who might not spend their weekends reading energy sector balance sheets, which is probably most of you, let's quickly frame up what AM actually does. AM is a pure-play energy infrastructure company.
Exactly. They operate the gathering pipelines, the compression stations, and the water handling assets.
Right, heavily concentrated in the Appalachian Basin. But the key to their entire business model, and really why we're talking about them today, is that they operate on fixed-fee contracts.
Yeah, that fixed fee structure is the absolute foundation of their value proposition. In the traditional energy sector, a company's revenue is wildly dependent on global commodity prices.
Like, if natural gas prices crash, revenue crashes.
Precisely. But AM operates as that toll road you mentioned in the intro. The natural gas producers take on all the commodity risk. Whether natural gas is selling for $2 or $8 on the open market, AM collects the exact same predetermined fee for every cubic foot that flows through their pipes.
It creates this highly insulated, incredibly predictable cash flow stream. Which brings us to why this matters to you, the everyday retail investor, right now. I mean, AM stock has surged roughly 271% over the last 3 years.
It's a massive run-up.
And on top of that capital appreciation, they are currently paying out a dividend yield hovering right around 3.9%, which translates to an annualized payout of $0.90 per share.
So you have a company generating steady, predictable income, yet its stock is behaving like a high-growth tech play. It's a fascinating tension between reliable yield and aggressive growth.
It is a really difficult tightrope to walk, and the only way we can understand how they are managing it and where their future cash flow is actually coming from is to unpack those transformational transactions they closed ahead of schedule this past February.
The big swap, right? Management essentially engineered a massive swap of their geographic footprint.
So let's get into the mechanics of that swap, because from the outside, buying and selling hundreds of millions of dollars in assets on the exact same day sounds chaotic. Like, how did this actually work?
It comes down to a deliberate high grading of their portfolio. So on one side of the ledger, AM acquired HG Midstream for $1.1 billion in cash.
Wow. Just $1 billion in cash.
Yep. And that purchase added about 50 miles of high-pressure pipelines in the Marcellus Shale. But more importantly, it came with over 400 undeveloped drilling locations. By bolting on those locations, AM effectively extended their development inventory by about 5 years.
Okay, that's huge.
Right, and then simultaneously, they turned around and sold off their legacy Ohio Utica Shale assets for $400 million.
Wait, let me make sure I'm wrapping my head around the logic here. So basically, it's kind of like trading a reliable but aging sedan for a high-performance sports car, but you use the trade-in value to offset the sticker shock. Or, like, they sold an apple orchard where the trees are getting old and have already stopped yielding as much fruit. They took the cash from that sale and bought a massive new plot of land that has 400 newly planted seeds ready to sprout.
That farming analogy gets right to the heart of the operational strategy. But the financial engineering underneath is what really makes this a masterclass in capital allocation.
Okay, lay it on me.
To understand why Wall Street loved this dual deal, we have to look at the valuation multiples. A multiple is essentially how many years of current cash flow a buyer is willing to pay to own an asset up front. AM managed to sell their mature, low-growth Utica assets at an 11x multiple.
Hold on. Why would anyone pay 11 times earnings for an aging low-growth asset? I mean, that sounds like the buyer got absolutely fleeced.
Not necessarily. It depends entirely on what the buyer's mandate is.
Hmm?
There are private equity firms and specialized late-stage operators whose entire business model is built on buying mature, declining assets that require zero new investment.
Oh, okay.
They just want to harvest the remaining cash flow like a bond,
Mm.
so they are totally happy to pay an 11x multiple for predictable, steady yield. But AM is a publicly traded company priced for growth. They need expanding cash flows.
Right.
So they sold that stagnant asset at a premium 11x multiple and then bought the high-growth HE Midstream assets at a much cheaper 7.5x multiple.
Buy cheap growth, sell expensive stagnation. I love the simplicity of it when you put it that way.
And it gets even better when you look at the capital synergies.
Yeah.
When AM buys those new HG assets, they don't have to build an entirely new corporate structure or construct new processing plants to handle the gas.
Because they already have the infrastructure nearby.
Exactly. They simply route the new production through their existing underutilized infrastructure. Because they are saving all that capital expenditure, their effective purchase price drops down to a 7.0x multiple.
That immediately explains the stock momentum. You are fundamentally upgrading the engine of the business while keeping the chassis the same. So they get, what, 900 million cubic feet per day of new throughput from this?
Yes, roughly 900 million cubic feet per day.
Yeah.
And free cash flow gets an instant 15% boost.
Which brings us to a critical inflection point for the deep dive. Because that 15% boost is the future, right? We need to look at what the baseline was before this massive new asset came online.
Okay, so compared to last quarter, what actually moved the needle here?
The defining characteristic of AM's fourth quarter of 2025 was structural resilience. If you recall, Q3 was an absolute monster.
Oh yeah, it was massive.
They posted record volumes that drove an astonishing 89% sequential growth in free cash flow. That is the kind of leap that usually makes analysts suspicious, you assume is a one-off anomaly. But Q4 proved the new baseline was real. They maintained that elevated performance, generating $192 million in free cash flow before dividends.
I have to stop you there because I am looking at the GAAP net income for Q4, and it tells a wildly different story. The net income dropped down to $52 million. That is a 52% drop year over year.
Yep.
For a retail investor who just reads the headline earnings release, seeing net income fall off a cliff while the stock is at 52-week highs is terrifying. Like, hold on, how does that actually affect AM's stock price for regular investors like me if net income just fell off a cliff? If the business is fundamentally thriving, why did it crater?
It is a crucial distinction to make, and it is exactly why sophisticated investors look past generally accepted accounting principles, or GAAP, when evaluating midstream companies. That 52% drop was not a reflection of operational weakness. It was almost entirely driven by one-time transaction costs related to the HG Midstream acquisition.
So we are talking about the lawyers, the bankers, the integration fees. Exactly. When you execute a $1.1 billion acquisition, you incur massive advisory and legal fees. Under accounting rules, those millions of dollars have to be recognized on the books immediately in Q4.
Which drags down the official net income.
Right. But those are non-recurring cash outlays. They have absolutely nothing to do with the day-to-day cash-generating power of the actual pipelines. That is why we focus heavily on adjusted EBITDA earnings. Before interest, taxes, depreciation, and amortization, which removes those one-time distortions.
Got it.
And in Q4, AM's adjusted EBITDA hit $285 million. That's a 4% increase year over year.
That makes total sense. It is like buying a rental property. You have to pay closing costs, appraisal fees, and broker commissions on day one. Your bank account takes a massive hit that month, but the underlying monthly rent you are collecting from the tenant hasn't changed at all.
A perfect parallel. And if we look at the historical context, that rental income has been growing for a very long time. In fact, 2025 officially marked AM's 11th consecutive year of EBITDA growth since their IPO in 2014.
11 straight years.
In the cyclical energy sector, maintaining an 11-year unbroken growth streak is incredibly rare. It signals a management team that knows exactly how to control costs and incrementally expand their footprint. Looking ahead to their 2026 guidance, which incorporates the new HG assets without those one-time fees, they expect EBITDA to jump significantly.
To what level?
Landing between $1.19 billion and $1.24 billion.
All right, I'm going to put my retail investor hat back on and push back here because this is the part that frustrates me. If they had an 11-year growth streak and they are projecting north of $1.2 billion in EBITDA next year, they are practically swimming in cash. Why is management keeping the annualized dividend completely flat at $0.90?
It's a fair question.
I mean, the 3.9% yield is fine, but in a world where I can get close to that on a risk-free treasury bond, why aren't they passing that 15% free cash flow gross directly back to the shareholders in the form of a dividend hike? Where is my money going?
It is the most common critique leveled at the company right now, honestly. But management's capital allocation strategy is highly deliberate. You have to look at how dividends function on a balance sheet. A dividend hike creates a permanent, recurring liability.
Right.
Once you raise it, the market punishes you severely if you ever have to cut it down the road. Instead of taking on that permanent burden, AM is prioritizing share buybacks. They still have $336 million remaining on their authorized share repurchase program.
Walk me through the mechanics of that, because a lot of investors hear share buybacks and just think of corporate executives trying to inflate their stock options. How does that actually help the everyday shareholder more than a cash dividend?
Think of the company's total valuation as a pizza. Right now, it is cut into a specific number of slices. Those are the outstanding shares. If AM takes their excess free cash flow and buys back their own stock from the open market, they're essentially retiring those shares forever. The pizza remains the exact same size, but there are fewer slices. Therefore, every remaining slice inherently represents a larger percentage of the company's total earnings.
So my shares become mathematically more valuable without me having to do anything, and I don't get taxed on it immediately like I would with a cash dividend payout.
That is the benefit to the investor. But the benefit to the company is even better. Every share they buy back and retire is a share they no longer have to pay that $1.96 dividend on next year or the year after that.
Oh, wow. I didn't even think about that.
Yeah, it functionally lowers their total dividend burden, which frees up even more cash flow in the future to pay down debt. And debt reduction is their other primary focus right now.
We are definitely going to dig into that debt in a minute because a billion-dollar shopping spree isn't free. But first, we need to contextualize these massive cash flow projections for 2026. AM isn't operating in a vacuum. There are macro tailwinds hitting the Appalachian Basin right now that sound almost unprecedented.
Unprecedented is the right word. We are looking at massive structural shifts in regional energy consumption. Energy analysts are currently projecting up to 5 billion cubic feet per day of incremental natural gas demand in the Appalachian region by 2030.
To put that in perspective for the listeners, 5 billion cubic feet per day is a staggering volume. That is enough natural gas to generate electricity for millions of homes. Where is all of this sudden demand coming from?
There are two main pillars driving this. First, you have the Gulf Coast liquefied natural gas, or LNG, export market. Global demand for American natural gas is surging, and AM's network in Appalachia ultimately feeds into the corridors that supply those massive export terminals.
Got it.
But the second pillar is the one completely reshaping the domestic power grid: artificial intelligence data centers.
Wait, with all this AI power demand, is AM secretly an AI play now? Like, are we essentially selling the shovels during the AI gold rush?
Right, but what does all that actually mean for AM investors? We have to separate the hype of the tech sector from the reality of the infrastructure sector.
Fair point, fair point. Ground me in the reality. Why does a massive AI language model care about an Appalachian pipeline?
It comes down to baseload power. The hyperscale data centers required to train and run massive AI models require an unfathomable amount of electricity. And more importantly, they require uninterrupted 247 power to maintain grid stability.
Because they can't afford to just shut down.
Exactly. You cannot power a gigawatt-scale AI data center entirely on wind or solar energy because those sources are intermittent. The wind stops blowing, the sun goes down. Until battery storage technology catches up, natural gas is the only reliable, scalable fuel source that can provide that constant baseload power.
That makes sense.
Now, consider geography. Virginia currently hosts roughly 35% of all hyperscale data centers worldwide. It is colloquially known as Data Center Alley, and the primary source of natural gas feeding the power plants in Virginia. The Appalachian Basin, which is precisely where AM has its pipeline footprint.
So AM is sitting geographically next door to the most energy-intensive technological development in human history. They are the toll road connecting the gas to the grid.
Yes, but to address your earlier question, they are not an AI stock, and they shouldn't be priced like one. Because AM operates on those fixed-fee contracts we discussed earlier, they do not capture the upside if natural gas prices spike due to this demand.
So if a massive power shortage drives gas prices to the moon, AM's fee remains exactly the same.
Right. What the AI boom provides for AM is extreme volume stability. It practically guarantees that their pipeline utilization rates will remain at maximum capacity for decades to come.
So the thesis here is ultimate predictability. As an investor, I am not going to see this stock gap up 500% overnight like a semiconductor company, but I gain the security of knowing the demand for the product flowing through my infrastructure isn't going to just vanish.
That is the bull case in a nutshell. But as with any deep dive, we cannot just look at the tailwinds. We have to stress test the thesis. Despite the guaranteed fees, the smart acquisitions, and the booming regional demand, AM has some very specific vulnerabilities.
Let's pull the thread on that. What is the single biggest risk sitting on AM's balance sheet right now?
Without question, it is customer concentration. Antero Midstream derives substantially all of its revenue from a single entity, its parent company, Antero Resources, commonly referred to as AR.
Okay, I want to challenge that because I've read through the filings. AR has long-term minimum volume commitments, or MVCs, with AM. That means AR is legally obligated to pay AM for a certain amount of pipeline capacity, whether they actually pump the gas or not. If we have ironclad contracts guaranteeing revenue, aren't we completely protected even if AR hits a rough patch?
You are protected from bankruptcy, sure, but you are not protected from stagnation. MVCs provide a critical revenue floor. They ensure the lights stay on and the current dividend gets paid. But remember, AM stock has run up 271%. Because investors are pricing it as a growth company. That growth narrative relies entirely on AR actively deploying capital, drilling new wells, and pushing incremental volumes through the new HG midstream assets.
Ah, I see the vulnerability. It's like building a massive state-of-the-art shopping mall, but you only have one single anchor tenant. Your lease guarantees you enough rent to pay the mortgage, but if that anchor tenant decides they don't want to expand their floor space or bring in new inventory, your foot traffic and your overall profit is completely capped.
That is the exact dynamic. If natural gas prices collapse globally and AR decides the economics are too poor to justify drilling new wells, they will slash their capital expenditures. If AR stops drilling, AM's volume growth flatlines instantly. Investors have zero direct exposure to commodity prices, but they have massive indirect exposure through AR's corporate drilling budget.
That is a significant caveat, and I imagine that risk is compounded by the debt they just took on. Let's talk about the elephant in the room. To finance that brilliant $1.1 billion HG acquisition, AM didn't just use cash on hand.
No, they didn't.
They took out a $700 million unsecured bridge loan. A bridge loan in today's interest rate environment. That sounds like a ticking time bomb if they can't refinance it favorably.
It is the primary headwind management is facing.
Yeah.
A bridge loan is typically a short-term instrument, usually lasting 364 days. It is designed to close the deal quickly, but it forces the company to go back into the capital markets to refinance that debt into long-term bonds relatively soon.
Right.
That fresh $700 million pushed AM's leverage ratio up to roughly 3.0x. Now, in historical midstream terms, 3.0x leverage is actually quite manageable. But context matters. We are currently navigating a higher for longer interest rate regime.
Right. The days of near zero interest rates are over. When they go to refinance that $700 million, the rates are going to be significantly higher than the debt they issued 3 or 4 years ago. How much is that going to eat into the free cash flow we were just celebrating?
It is going to take a real bite. Every additional percentage point in interest they have to pay on that debt represents millions of dollars annually that vanish from the bottom line.
Wow.
That is cash. They cannot be used to buy back shares, cannot be used to maintain the pipelines, and certainly cannot be used to hike your dividend. This is exactly why management's decision to keep the dividend flat and aggressively prioritize debt reduction isn't just conservative, it is a financial necessity to protect the balance sheet against rate volatility.
It's the unglamorous reality of corporate finance. Taking out the trash and paying down the credit card before you buy a new TV.
Okay, let's zoom out and pull all these threads together. We are looking at an incredibly efficient yield-generating machine. AM boasts an historic 11-year streak of EBITDA growth.
Yep.
They have fundamentally upgraded their future cash flows by swapping stagnant Utica assets for high-growth Marcellus assets. And they're positioned perfectly geographically to benefit from a 5 billion cubic foot per day demand wave driven by LNG and AI data centers.
But that optimism must be weighed against their distinct vulnerabilities. They're inextricably tethered to the drilling budget of a single customer in Antero Resources, and they have a $700 million refinancing hurdle they must clear in a challenging interest rate environment. Yeah, that's a lot to balance.
The market seems to be betting on the bull case right now, with recent upgrades from Goldman Sachs pushing their price target to $23 and UBS raising theirs to $24.
And the stock is hovering right near those 52-week highs as we record this. It really comes down to whether you believe the macro tailwinds will overpower the balance sheet risks.
And as we wrap up, I want to leave you with one final thought to mull over. We discussed the AI data center boom and the immense baseload power required to sustain it. If that technological expansion accelerates faster than the current electrical grid can handle a scenario, many energy experts are currently predicting what happens to the underlying value of AM's network.
That's a great question.
Could their specific Appalachian pipeline infrastructure transition from being just a reliable midstream asset into an irreplaceable premium valued choke point for East Coast power generation? I mean, if you own the only functional toll road to the biggest technological hub in the world during an acute energy shortage, the fundamental value of that road changes dramatically.
That is a massive paradigm shift. A regional midstream pipeline company suddenly evolving into a critical piece of national security infrastructure for AI dominance. I love it. All right, listeners, what's your take on the future of AM? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Bite Size Brief.